Section 129E of TILA was enacted on July 21, 2010 by Section 1472 of the Dodd-Frank Wall Street Reform and Consumer Protection Act. Section 129E established new requirements for appraisal independence for consumer credit transactions secured by the consumer's principal dwelling. The amendments were designed to ensure that real estate appraisals used to support creditors' underwriting decisions are based on the appraiser's independent professional judgment, free of any influence or pressure that may be exerted by parties that have an interest in the transaction. The amendments also sought to ensure that creditors and their agents pay customary and reasonable fees to appraisers. It is important to understand that the appraisal changes that were made were promulgated in a legislatively directed interim final rule. The final rule was issued without notice or comment, which typically will impact changes to interim rules. The reason it was issued without notice or comment is because Congress imposed a 90-day deadline for issuing the final rule, and notice and comment would make the timeline impractical. Under 129E, the following actions are prohibited: mischaracterizing or suborning a mischaracterization of the appraisal value of the securing property, seeking to influence the appraiser or otherwise to encourage a targeted value to facilitate the making or pricing of the transaction, and withholding or threatening to withhold timely payment for an appraisal report or for appraisal services rendered. Section 1471 of the Dodd-Frank Act's Title 14, Subtitle F, regarding appraisal activities, added a new TILA section 129H, which establishes appraisal requirements that apply to higher risk mortgages, also known as higher price loans. Specifically, TILA Section 129H prohibits a creditor from extending credit in the form of a higher risk mortgage loan to any consumer without first obtaining a written appraisal performed by a certified or licensed appraiser who conducts a physical property visit of the interior of the property, or obtaining an additional appraisal from a different certified or licensed appraiser if the higher risk mortgage finances the purchase or acquisition of a property from a seller at a higher price than the seller paid within 180 days of the seller's purchase or acquisition. The additional appraisal must include an analysis of the difference in the sale prices, changes in the market conditions, and any improvements made to the property between the date of the previous sale and the current sale. The appraisal regulations under TILA 129E apply to the following: to a person who extends credit or provides services in connection with a consumer credit transaction secured by a consumer's principal dwelling, to appraisals for any consumer credit transaction secured by the consumer's principal dwelling, to the persons that provide services without regard to whether they also extend consumer credit by originating mortgage loans. The interim final rule applies to creditors, appraisal management companies, appraisers, mortgage brokers, realtors, title insurers, and other firms that provide settlement services, to closed-in loans and HELOCs, and also to any person who performs valuation services, performs valuation management functions, and to any valuation of the consumer's principal dwelling, not just to a licensed or certified appraiser, an appraisal management company, or to a formal appraisal. This is designed to ensure that consumers are protected regardless of the valuation method chosen by the creditor, and to prevent circumvention of the appraisal independence rules.